So, everyone wants to beat the market. It's the ultimate goal, right? You see the headlines, you hear the stories of traders who turned a few $1,000s into a fortune, and you think, how do they actually do it? Is it just luck, or is there a real, repeatable process behind it? The reality is, while most people who try to time the market end up losing money, there are specific data-backed strategies that have historically shown an edge. It's not about getting lucky on a meme stock. It's about having a system, a set of rules that you follow religiously, without emotion. And that's exactly what we're going to break down today. I've spent countless hours digging through back-tested data, looking at what actually works over the long term, not just in a bull market. We're going to go through count them, 5 entirely different trading strategies that have proven, through historical backtesting, to have the potential to outperform a simple buy and hold strategy. So, do me a quick favor and hit the like button for the YouTube algorithm if you're ready to get into the nitty-gritty of what actually works. Alright, first up, we have what is probably the most classic and well-known trading strategy of all time, trend following using a moving average crossover. The philosophy here is incredibly simple, and that's part of its beauty. The trend is your friend. Instead of trying to predict where the market is going, you simply wait for the market to establish a clear direction, and then you jump on for the ride. You're not trying to be a hero and catch the exact bottom or top. You're just trying to capture the big, meaty part of a major move, whether it's up or down. The most common way to do this is with the golden cross and the death cross. This involves using two moving averages on a chart, a short-term one like the 50-day moving average, and a long-term one like the 200-day moving average. The entry signal is straightforward. When the faster 50-day MA crosses above the slower 200-day MA, it's a golden cross, a buy signal. You enter a long position. The exit signal is the opposite. When the 50-day MA crosses below the 200-day MA, it's a death cross, a sell signal. You exit your position and either go to cash or even enter a short position. Now let's talk numbers because that's what really matters. Okay, let's move on. Complete philosophical opposite of trend following. This is mean reversion. Core idea. Prices can't go one way forever. When pushed too far, too fast. Up. When pushed too far, too fast. Down. Stretched like a rubber band. Strategy profits from the snapback to the mean. Tool. Relative Strength Index. RSI. RSI oscillates between 0 and 100. RSI below 30. Oversold. Price fell too hard. Might bounce. RSI above 70. Overbought. Price rose too fast. Could pull back. Systematic buying fear. Selling greed. Entry-exit rules are clear. For longs, wait for RSI to dip below 30. Don't buy blindly. Wait for RSI to cross back above 30 to enter. Confirms downward momentum is fading. Exit when RSI crosses jocker $50, or when RSI reaches 70, overbought. For shorts, enter when RSI crosses back below 70, exit around 50, or exit around 30. Backtested results, shorter time frames, intraday, daily charts, win rates often 60-75%. Feels great psychologically. Many small wins, small consistent profits. Average trade lasts hours to days. Expectancy can be positive in the right markets. However, the risk is the mirror of trend following. Trend following. Many small losses, a few big winners. Mean reversion, many small wins, a few catastrophic losses. Danger of catching a falling knife. You might buy RSI 25 expecting bounce, but company could be dying, stock to zero. RSI can stay oversold a very, very long time. One bad trade can erase weeks or months of profits. Risk management is non-negotiable. Hard stop loss is essential. Define exact stop before entry. Prevents a small bet becoming a portfolio disaster. Best in range-bound or gently trending markets. Confluence. Price bouncing off support with RSI oversold. Terrible in strong one-directional trends. Short a rocket ship. Or buy a falling anvil. Add confirmation filters to improve robustness. Only buy oversold if price touches key support, or touches a long-term moving average. Look for bullish candles, hammer, or engulfing candle in oversold zone. Mean reversion with RSI. Scalp small, frequent profits. Wins often but hidden risk of rare large losses without strict stops. Be humble. Admit when you're wrong quickly. hit singles and doubles, avoid striking out for good. Chapter 3. Next up, we have a strategy that's all about action and momentum, the breakout strategy. The core concept, periods of low volatility and quiet, sideways price action are often followed by periods of high volatility and strong directional moves. Think of it like a pressure cooker. The price gets compressed into a tight range, building up energy. A breakout trader's job is to be ready to jump on board the moment that energy is released. You're not trying to predict the direction, you're waiting for the market to show its hand with a decisive move. There are several ways to identify these consolidation zones. Simple method, drawing horizontal lines to create a box. Box around the recent highs, box around the recent lows. More systematic, Bollinger Bands, or Donchian channels. Donchian plots the highest high and the lowest low. A breakout occurs when price closes above the 20-day high, a long entry, or when it closes below the 20-day low, a short entry. A new 20-day high is a sign of significant strength. The entry trigger is the breakout itself, a close outside the established range, but many traders wait for confirmation to avoid false breakouts. Common confirmation, waiting for increased volume on the breakout. Another, a retest where old resistance becomes support before moving higher again. Entering on the retest can offer a better risk-to-reward ratio. Backtested performance, breakout strategies often have a lower win rate, typically 30 to 50%. The reason is false breakouts. The market pokes above a level, sucks in buyers, then reverses. Profitability depends entirely on the risk-reward profile of the winners. Winners have to be significantly larger than losers. A good breakout can kick off a major new trend that runs for days or weeks. Common target, at least a 2-to-1 reward to risk, or aim for 3-to-1. Example, if you risk $100, target $200, or target $300. Biggest challenge, managing false breakouts. Stop loss placement is critical. A typical stop for a long breakout is placed back inside the range, often below the midpoint, or back below the bottom of the range to give the trade room. Accept false breakouts as a cost of doing business and manage risk so they don't cause big damage. Traders use filters to improve the odds. One powerful filter is volatility. Look for breakouts after a period of unusually low volatility measured by ATR. When ATR hits a multi-week low, it signals the pressure cooker is building. That subsequent breakout is more likely to be explosive and sustained. So the breakout strategy is for traders who want to be involved at the start of big, powerful moves. It requires you to be comfortable with a lower win rate and discipline to cut losses quickly on fakeouts. Success hinges on capturing those explosive trend-starting moves that deliver outsized gains. Be patient during the quiet times and decisive when the action starts. Chapter 4. Alright, our fourth strategy is one that feels counterintuitive to anyone taught to buy low, sell high. This is momentum trading. Core principle, strong recent performers tend to stay strong. Winners keep winning. You seek the strongest stocks rather than bargains. You often buy at or near 52-week highs. Identify momentum via relative strength, not RSI. Relative strength compares assets to each other. For example, rank S&P 500 stocks by performance over the last 3 months, 6 months, 12 months. Buy the top, 10%, 20%. Systematically stay invested in the market's strongest parts. Use MACD to gauge momentum. MACD shows trend strength and direction. Buy when MACD crosses above its signal line, especially if MACD is above 0. That signals accelerating upside momentum. Hold while MACD remains bullish. Exit when it crosses back below the signal line. Backtests show a strong momentum premium. Academic studies. Momentum portfolios have outperformed for decades. Hit rate for trades often above 50%. The strategy lets winners run and can produce substantial gains. Main drawback. Momentum can suffer sharp sudden crashes. When sentiment shifts abruptly, dot-com bubble burst, 2008 financial crisis, these events cause big drawdowns if unprepared. It can feel like you're on top of the world, then lose much in months. Manage risk with systematic rebalancing and review. Review your portfolio monthly, quarterly. At each review, sell those that fell out of the top bracket and replace them with new leaders. This disciplined rotation prevents emotional attachment to winners. Cut laggards and keep riding leaders. diversify and use stop losses as key risk controls. Instead of betting on 1 or 2 stocks, apply momentum to a portfolio of 10 to 30 stocks. Use a trailing stop loss on each position. For example, a stop always 15% below the highest price since purchase. Momentum trading, data-backed, buys the market's strongest performers. It requires overcoming the psychology of buying what's already expensive, historically market-beating, but risks sharp drawdowns when trends reverse. Success, disciplined rules-based rebalancing, plus strict risk management to lock gains and survive crashes. Chapter 5. Finally, we arrive at the most complex and quantitative strategy on our list, statistical arbitrage, often referred to as pair trading. This is a market-neutral strategy designed to make money regardless of market direction. Instead of betting on one stock, you bet on the relationship between 2 correlated stocks. The goal is to find a pair that historically move together, wait for them to drift apart, and then bet they'll converge. The first step, finding a suitable pair. You can't just pick any 2 stocks like Ford and Google. You need 2 securities with a strong economic reason to be linked. For example, Coca-Cola, Pepsi, JP Morgan, Bank of America. You then run a co-integration test to mathematically prove a long-term, stable relationship. A high correlation is good, but co-integration is the gold standard. Once you have your co-integrated pair, you create a spread by tracking the price ratio or the price difference between the 2 stocks. You then calculate the historical average of this spread and its standard deviation. Trading signals are generated when the current spread deviates significantly from its historical average. For example, you might enter a trade when the spread moves 2 standard deviations away from the mean. If stock A becomes overpriced relative to stock B, short stock A, buy stock B. The profit comes when the relationship reverts to the mean. As the spread narrows and returns to its historical average, your combined position becomes profitable. Exit when the spread crosses back over its mean. This strategy is a pure numbers game, exploiting temporary statistical anomalies in the market. The back-tested performance of pair trading can be very attractive, particularly from a risk-adjusted perspective. Because it is market-neutral, it tends to have a very low correlation to the overall stock market. This can lead to a much smoother equity curve and a significantly higher Sharpe ratio. The drawdowns are typically much smaller and more contained. However, this strategy is not without its own unique and serious risks. The biggest one is model decay or a structural break. For example, one company might get acquired, face a major scandal, or release a revolutionary new product that causes its stock to permanently diverge from its partner. When this happens, the spread doesn't revert to the mean and your position can incur massive, theoretically unlimited losses. Furthermore, there are significant practical considerations. Because the profit per trade is often very small, you need to trade with significant size to make it worthwhile. Execution costs, like commissions and slippage, can eat away a large portion of the profits. You have to execute 2 trades simultaneously, which can be tricky and adds to the cost. This is why statistical arbitrage has traditionally been the domain of hedge funds and high-frequency trading firms. Outro. So there you have it. 5 completely different data-backed strategies that have historically shown the potential to beat the market. We covered everything from riding long-term trends with moving averages, scalping small profits with mean reversion, catching explosive moves with breakouts, buying strength with momentum, and even exploiting statistical relationships with pair trading. As you can see, there's no single best way to trade. Each strategy has its own unique personality, its own strengths, and its own very real weaknesses and risks. The most important takeaway here isn't to just blindly copy one of these strategies. The goal is to understand the logic behind them and find a style that aligns with your own personality, risk tolerance, time commitment. Are you patient enough for trend following, disciplined enough for mean reversion, or do you have the statistical chops for pair trading? The strategy that you can stick with, through both the winning streaks and the inevitable losing streaks, is the one that has the best chance of working for you in the long run. Real success in trading comes from consistency, not from finding a magic formula.